Well, some good news now. The South African Reserve Bank has cut the repo rate by 25 basis points. Now, the repo rate is at 6.5%, which means the prime lending rate can now be adjusted to 10%. Well, investment strategist Keorapetse Leballo is here to explain the reasons behind the decisions, but also what it means for ordinary folk like some of us. No surprise, really, in the decision. It was to be expected, wasn't it?
Correct, it was to be expected. If you actually look at some of the outlook on inflation, thus far we've actually seen a very weak inflation trajectory, and it's expected for us to actually continue on that weak inflation trajectory going forward. Food price inflation has actually come down quite significantly and is expected to stay low. A bit of, I guess, scaling back in as far as household credit extensions are concerned from the banking sector also actually created room for the Reserve Bank to actually cut interest rates lower because we still have an overly indebted household sector.
So the risks to the country's inflation outlook, have they really subsided, or are they still pretty much what they were only a couple of months ago?
Well, we are actually very wary with, the outlook in as far as inflation is concerned. This is the narrative from the side of the Reserve Bank. But when coming to our side, actually, we are looking at a normalization in oil prices globally. We are looking at a rebound in the trade-weighted value of the United States dollar. We are still worried with the twin deficits in South Africa. And all these risks actually point toward actually inflation picking up from current levels. In the quarters to come, we are expecting that there will be further tariff hikes in as far as electricity prices are concerned. That will also weigh heavily on the consumer. And taking into account the fact that now the VAT prices are going up, as well as fuel-based levies are also increasing. So it does not bode well for the near-term inflationary outlook.
So the Reserve Bank narrative is not quite, you don't quite agree with it, is that what you're saying?
Not necessarily. I do not quite agree with it, but I see it as a stance that will be generally welcomed by the overly indebted consumers. I mean, just to put it into perspective, the overall household debt to disposable income ratio in South Africa is sitting north of 72%, meaning 72% of the income that South African households generate goes towards servicing debt. So any level in a cut in interest rates will give households actually enough, I guess, some breathing room.
Do you share Lesetja Kganyago's, optimism? Say, well, economic growth is more positive, even though it's still challenging.
Yes, I mean, the trajectory is on the up, but we are still operating at less than full employment level. We still have unemployment rates still relatively close to 28%. Again, we are running twin deficits where now we have a fiscal deficit and we also have a current account deficit. There's high levels of, or rather subdued levels of corporate profitability levels in South Africa. All actually that suggests to us is that although we expect an uptick in GDP, well, largely as a function of the world economic outlook actually improving, not necessarily by what we are doing here in our shores. We are less optimistic than the Reserve Bank is in as far as our GDP forecasts are concerned. Well,
you had the president, was it yesterday or the day before, announcing, another initiative to create jobs for young people, especially. What more do we still need to do? Or what more can we do immediately?
I don't see an immediate quick fix, and I don't think that the repo rate, cutting the repo rate will also be an immediate quick fix. I mean, we're only cutting the repo rate by 25 basis points. So GDP growth rates are less sensitive to cuts in repo rates. It's more of the inflation outlook that is actually more sensitive. It's actually now in the policy side of things, in the fiscal policy side of things. What can we do in order to further stimulate growth? But we have very limited avenues. We still have our debt to GDP ratio expected to be north of 50% on average over the next 2 years. So we don't have much room for actually further extending our budget deficit. So there are still a bit of limitations on that end, but it will largely subside going forward owing to the fact that the world economic outlook is actually on an upward trajectory.
Keorapetse, thanks very much for coming through this evening.
Thank you.
He is, of course, an investment strategist.